Minimum Viable Product (MVP) is the smallest set of features that lets a new product be launched, collect real user feedback, and prove that a market need exists. Think of it like a chef's first rough version of a new dish. A few core ingredients, cooked simply, served to a few diners to see if they like it before perfecting the recipe. Introduction: the product is new, sales are low, costs are high, marketing and setup. The focus is on awareness and getting early adopters. Analogy: a movie premiere, few tickets sold, heavy advertising. Growth: the product gains acceptance, sales rise rapidly, economies of scale, lower unit cost. Companies invest in distribution and feature expansion. Analogy: a viral video that spreads quickly and gets more views each day. Maturity: market saturation is reached, sales growth slows, competition is intense, profit margins stabilize. The goal shifts to defending market share, optimizing operations, and incremental improvements. Analogy: a popular song that stays on the charts for months. Everyone knows it, but there are many cover versions. Decline: sales fall as the market shrinks or technology is replaced. Companies may harvest profit, discontinue, or reinvent. Analogy: a classic TV show that ends its run and is replaced by newer series. Each phase has distinct strategic priorities, cost structures, and risk levels, which guide decisions from the MVP onward. Explanation: performance measurement must match the phase's objectives. Introduction: KPIs, customer acquisition cost (CAC), activation rate, early user satisfaction (NPS), churn of the first cohort, time to feedback. Framework: funnel, impressions to clicks to signups to activated users to feedback. Use cohort analysis to see how early groups behave over time. Growth: KPIs, monthly recurring revenue MRR, growth rate, churn rate, lifetime value LTV, viral coefficient K, average revenue per user RPU. Framework: balanced scorecard, financial MRR, gross margin, customer net retention, internal processes, release cycle speed, learning, feature adoption. Maturity: KPIs, net profit margin, market share, cost to serve, product line profitability, brand equity. Framework: portfolio view, allocate resources based on ROI, use profit per employee and cash conversion cycle. Declines: KPIs, cash flow from the product, cost to maintain, exit ROI, salvage value. Framework: decision tree, continue, harvest, or divest based on projected cash flows versus opportunity cost. The key is to pick a handful of clear, quantifiable metrics that directly link to the strategic goal of the current lifecycle stage. A solid financial view of an MVP tells whether the idea can survive its early days. Cost structure breakdown: fixed costs, abbreviated FC, development salaries, core platform licensing, initial tooling, legal and IP fees. Variable costs, abbreviated VC, per user, cloud hosting, customer support, payment processing fees, marketing spend tied to acquisition. Break-even point: the break-even volume Q* is where total revenue equals total cost. Total revenue equals price times quantity. Total cost equals fixed costs plus variable cost times quantity. Set revenue equals cost implies price times Q* equals fixed costs plus variable costs times Q*. Q* equals fixed costs divided by price minus variable costs. If price equals $50, variable cost equals $10, fixed costs equals $200,000, implies Q* equals 200,000 divided by 40 equals 5,000 units. NPV, net present value. Calculate cash flows for a forecast horizon, for example 3 years. Discount them using the company's hurdle rate R. NPV equals sum from T equals 1 to N of cash flow at T, divided by 1 plus R to the power of T minus initial investment. Assume yearly cash flows. Year 1 equals $80,000, Year 2 equals $120,000, Year 3 equals $150,000, R equals 12%. NPV equals 80,000 divided by 1.12 plus 120,000 divided by 1.12 squared plus 150,000 divided by 1.12 cubed minus 200,000 equals approximately 71,000 plus 96,000 plus 107,000 minus 200,000 equals $74,000. A positive NPV means the MVP adds value. IRR, internal rate of returns. IRR is the discount rate that makes NPV equals 0. Solve. 0 equals sum of cash flow at T divided by 1 plus internal rate of return to the power of T minus initial investment. Using the same cash flows, trial and error or Excel's IRR gives IRR approximately 27%, well above the hurdle rate, confirming the MVP is financially attractive. These calculations must be revisited after the pilot, as real numbers replace assumptions. Understanding market size helps decide how far the MVP can be scaled. Definitions. TAM, total addressable market, dash the revenue opportunity if every possible customer bought the product. SAM, serviceable available market, dash the portion of TAM that the company can realistically target given geography, channels, and regulations. SOM, serviceable obtainable market, dash the share of SAM the firm expects to capture in the near term, often 1 to 3 years. Example a SAS tool for small restaurant inventory. TAM, all restaurants worldwide approximately 1 million units times $500 average, spend equals $500 million. SAM, restaurants in North America, where the firm has sales support approximately 250,000 times $500 equals $125 million. SOM, first 2 years, 5% of SAM equals $6.25 million. Scaling projections. Assume the MVP captures SOM in year 1, and growth follows a constant percentage increase G the projected revenue in year T. Revenue T equals SOM times 1 plus G to the power of T minus 1. If G equals 40%, typical for a fast-growing SAS then. Year 1, $6.25 million. Year 2, $6.25 million times 1.40 equals $8.75 million. Year 3, $8.75 million times 1.40, approximately equals $12.25 million. These simple models give a back-of-the-edge view. Later, more sophisticated cohort and churn models replace the constant growth assumption. The quantitative market sizing guides fundraising goals, resource allocation, and timeline for moving from MVP to a full-scale growth strategy. Explanation: pricing must evolve as the product moves through its life cycle, reflecting market perception, competition, and cost structure. Price elasticity of demand, E. E equals percent change in quantity, demanded divided by percent change in price. Absolute E greater than 1 indicates elastic, meaning a small price change causes a large quantity change. Absolute E less than 1 indicates inelastic, meaning quantity changes little with price. Introduction: MVP goal is to recoup early costs and attract early adopters willing to pay a premium for novelty. Use price skimming, set a high price, capture high-value users, then lower later. Example: a new smartwatch sold at $500 initially. Growth: as adoption spreads, price may be lowered to capture price-sensitive segments. Apply price elasticity-based optimization. Optimal price P star equals MC divided by 1 plus 1 over E, where MC is marginal cost. If MC equals $100 and estimated E equals -2, then P star equals 100 divided by 1 minus 0.5 equals $200. Maturity: competition is fierce. Price becomes more inelastic as customers are loyal. Companies shift to value-based pricing, bundling features and tiered plans while maintaining profit margins. Decline: prices may be cut further to liquidate inventory or maintain cash flow. Penetration pricing can prolong the tail. Practical example: a cloud storage service. MVP, $15 per month, skimming early adopters. Growth: elasticity measured at -1.5, P star approximately $12 per month. Maturity: introduce tiers, $5 basic, $12 standard, $20 premium. The basic tier captures price-sensitive users, premium retains high-margin customers. Monitoring elasticity through A/B pricing experiments enables data-driven price adjustments at each stage. Explanation: portfolio management tools help decide how much money, talent, and time to give to each product stage. BCG Matrix Boston Consulting Group, Axis market growth rate vertical versus relative market share horizontal. Quadrant 1 stars high growth, high share usually growth phase products invest heavily. Quadrant 2 question marks or problem children high growth low share typical of an MVP that has not yet proved traction decide to invest or divest. Quadrant 3 cash cows low growth high share mature products generating steady cash harvest profits. Quadrant 4 dogs low growth low share declining products consider phase out. Application a company with 3 offerings MVP for AI-based analytics question mark 15% share in a 30% growth market leads to allocate a measured budget to scale if early metrics are positive. Established SaaS CRM cash cow 45% share in a 5% market leads to fund research and development or cross-sell. Legacy on-premise ERP dog 5% share in a 2% market leads to plan sunset. GE McKinsey Matrix axes industry attractiveness multi-factor versus business unit strength. Each axis is scored 1 to 9. Cells are categorized as invest or grow selectivity or earn or harvest or divest. This matrix adds nuance, for example profitability barriers, to entry beyond simple growth share. Resource allocation example suppose the MVP scores 7 on attractiveness fast-growing AI market, but 4 on strength new brand it falls into selectivity or earn allocate modest funds for validation, then move to invest or grow if it reaches a strength greater than or equal to 6. Using these matrices, senior managers can visualize the portfolio mix, prioritize funding, and justify decisions to investors. Explanation: forecasting how fast customers adopt a new product guides when to shift resources from MVP to growth. Bass diffusion model. The model describes the adoption rate over time. Adoption of T equals P multiplied by M minus N of T minus 1, plus Q multiplied by N of T minus 1 divided by M, multiplied by M minus N of T minus 1. Where M equals market potential, total number of adopters, that is TAM or SAM. N of T minus 1 equals cumulative adopters up to period T minus 1. P equals coefficient of innovation, external influence, for example advertising. Q equals coefficient of imitation, internal influence, word of mouth. Simplified continuous form. F of T equals P plus Q times F of T, multiplied by 1 minus F of T. With F of T equals N of T divided by M, fraction of market adopted. Example, a new mobile fitness app. M equals 1 million potential users. P equals 0.02, 2% of the market adopts each month via ads. Q equals 0.38, strong word of mouth. Using the discrete formula, the forecast shows a slow start, a rapid climb around month 6 to 8, then tapering as saturation approaches. Sensitivity analysis. Vary P to see impact of increased marketing spend. Higher P lifts early adoption but may not change the peak much. Vary Q to reflect product virality. A higher Q dramatically steepens the curve, reducing time to reach the growth stage threshold, for example 10% market share. Transition timing decision management can set a rule. When cumulative adopters N of T hit a predefined percent of M, say 5%, or when the adoption rate F of T exceeds a growth stage benchmark, for example 20,000 new users per month, shift budget from MVP validation to scaling, hiring sales, expanding infrastructure. Running the BAS model with different P and Q scenarios in a spreadsheet or simulation lets leaders see how marketing spend or product improvements affect the timing of that shift, enabling data